Welcome to Trade with Books English channel, and today I am going to explain you one option trading strategy which is useful for bearish market. This video is purely for trader mindset people who want to use this opportunity of bearish market to earn some extra income with limited risk. I am going to explain you an option trading strategy which have very limited risk, not like your full capital will go. For a month you can deploy this strategy in those stocks which are in bearish momentum, because when all shares are in bearish momentum, market is in bearish mode, you cannot deploy your swing trading strategy. Any swing trading strategy for uptrend has the first rule that your overall market should be uptrending. I have read many books and all books says the same thing. You should stop your swing trading for the time until unless Nifty will start making higher high, higher low in weekly time frame. So until that, what you will do, if you want to do some trading, this is one strategy you can useful. This will be very useful. You can learn this, and if you don't want to use this also, start to learn this option trading. This is not that much harmful or that much dangerous that people tells. If you do it with proper rules and with some strategies where your risk is defined, this is also very gainful. So this strategy name is bear put spread. Your view is bearish and you are making this strategy with the put option. Put option generally people buys when they have some bearish view in the stock. So from starting onwards, I'm going to explain you. This is one strategy I made for Zomato, where the risk is 9,000 and reward is 11,000, and probability of profit is almost 49%. If the stock goes below 221, I will be in the profit. So stock is currently at around 230 maybe. Spot price is 221 only. So if the stock goes below that 220, I will be in the profit. So this is very simple strategy, and once you made this strategy, no adjustment, nothing you have to do. First of all, before making the strategy, you have to accept the risk of 9,000. If you are ready to accept the risk of 9,000, then you can deploy the strategy. Profit is 11,000 if Zomato will be below 220 for the full time. Any time in between, if you want to book the profit, you can book it before expiry. Suppose 27th March is the expiry. If you want to book the profit on 15th March, whatever profit will be, it will not be that 11,000, it will be around 6, 7, 8,000 that you can book if Zomato will be below 220. So first of all, you should analyze the stock, that whether the stock is overvalued and the chances of stock going down is higher, then you can put this strategy. So for that, I am taking one example of BHEL. One share is there, BHEL. I will show you how you should start with the stock selection, and then how you can create that strategy for BHEL, Bharat Heavy Electronics Limited, if you want to deploy this bear put spread strategy. Bear put spread strategy. Spread means one option you are buying, one option you are selling. This is called a simple spread. Your view is bearish and you are making this spread with the put option. That's why the strategy name is bear put spread. Okay, Mansilai. Bharat Heavy Electricals Limited, why I have chosen, just for your example, like that only you should choose these stocks. Or you can deploy the same strategy in index also. Nifty, Bank Nifty, Sensex, this all area you can deploy this strategy. You can deploy this in index for maybe for weekly options or monthly option, but in stocks only monthly options are available. Okay, stocks there are up to 3 months options are available. Suppose we are in March 2025, so currently for March 25, April 25 and May 25 options are available, but May options are illiquid. There for stocks you will not get that bid and ask, so don't do for that much far. Best thing is to do in index, Nifty and Bank Nifty. If you are very sure about the bearish movement of any stock, if you have conviction that this stock is very high valued, then you can deploy that strategy in the stock also. because stocks fall a lot. You have seen that Nifty has fallen only 15%, but many of the stocks had already fallen 50-60%. This BHEL also you see 45% it has fallen, whereas Nifty has fallen only 15%. So this is clearly a weak stock. And so first of all, you have to see the chart, that what is the chart showing, whether it is in bearish movement, clearly bearish movement, no confusion. Then you have to see the fundamentals also. Fundamentals, how you can judge the PEG ratio, the profit growth based criteria of judging a stock's valuation. You should see how you should see stocks PE is currently 120. BHEL PE ratio is currently 120. Now the simple thing is which you can use is, if PE ratio is current PE ratio is lesser than the TTM profit growth, that data also you will get here. Here if you go to the bottom, one table will come like this, and here this compounded profit growth is written, and here it is written TTM profit growth. This is free site, screener.in. This is showing that last 12 months, TTM means trailing 12 months, means in last 12 months the company has generated a 15% profit, 15%. So valuation says that stocks P ratio should be either 15 or less than 15. P ratio should be either 15 or less than 15 based on that PEG ratio concept, that you need not to worry. Just remember that this is the criteria. TTM P ratio should be the ideal P. Now stocks P is currently 120. I am telling about 15p, currently it is 120p. This is just for explanation, just for your understanding. This is not a recommendation that you go and buy a put option of BHEL simply without your analysis. Like this you can select stocks. What I'm trying to tell is, so with this fundamental analysis I got to know that BHEL stock prices may be overvalued, because as per my analysis. So I am trying to short the BHEL because BHEL is overvalued, because I want to capture this opportunity of bearish market also. I will not wait for bull market so that I will be doing swing trading. I want to do something with small capital, with smaller risk in this bearish market also. So now I have decided that BHEL is the stock based on fundamental and technical, which is weaker than market. If you put relative strength model also, like I shown you, everything I am showing you in this one video, here you have to put that indicator called relative strength of a stock. Relative strength of a stock by Bharat Trader. If you apply here, you will see that when we'll select that 26 September data, like here somewhere 26 September is where, 26 September somewhere here, because Nifty is falling from 26 September. 26 September is around somewhere here. This is weekly chart actually. We have to convert this to daily chart because we are watching in RS123 model. So if you see that simply RS123 also, which I have explained in one of my video, you can watch in my channel RS123 video, which shows that if RS123 in daily chart, in weekly chart, if you want to see, you have to see RS21 period. In daily chart, 123 is showing that it is below zero line, so it is weaker than Nifty. Now with technical and fundamental, I am convinced that stock is overvalued and it is weaker than Nifty. Overall market is in bearish mode. So now I want to take a bearish trade with options in BHEL. How I will make that? So first of all, you have to come to this Opstra. Opstra website is there, opstra.defineedge. In here you have to log in with your Gmail ID. Okay. Now if I want to make a strategy with BHEL, how I have to make, one by one I will show you. This you can use in Nifty also. Currently it is showing Nifty. So where it is showing this Nifty, here you have to select BHEL. First of all, this area you have to select BHEL. So I will click it, I will write BHEL, and BHEL comes. Now what data it is showing, that spot price is 179. Currently stock is trading at 179. Future price is 180. That future and option future price is 180. And lot size is 2625. Means in one lot 2625 number of shares are coming. Okay, now this data you don't look now, and currently it is selected as future 27th March, but we want to do in options. So this future I will click and I will select options. Okay, options, and here it is coming 27th March. If you click, these three dates are coming because all stocks have three expiries: current month, next month, and far month. 27th March, 24th April, and 29th May. Last Thursday of every month. But I am telling you, for stocks, you don't go to this much far because liquidity will not be there. Means there will not be sufficient buyer and sellers. So for current month, we should do. For some of the stocks like Reliance, TCS, far month also option have sufficient liquidity. In those stocks, you can do far month contracts also. For some of the stocks like BHEL, you should be restricted to nearest month like 27th March. Now, what bear put spread strategy says is you have to buy one put option, and for hedging means limiting your risk, you have to sell one put option. Okay, this is the strategy. Now, one simple thing is somebody can ask me that why not simply buy a put option and sit here? Need not to hedge, need not to make any strategy. So that also we will see. Currently stock price is at 180. If I will buy 180 put option, I will buy a PE of 180, put option of 180, and I will buy it. What is my risk? What is my reward? So 22,000 is the risk if I buy naked plain put option without any hedge. 180 put option I bought, and my risk is 22,000, and my reward is unlimited if stock comes below the level of 171. If stock comes below 171, I will be in profit, but if it doesn't come, my risk is 22,000, and I need 22,000 money only. But I don't want to risk 22,000. I want to risk lesser. Then what to do? Then you have to hedge. So for that hedging, what you have to do, suppose you have bought 180 put option, then you have to sell a put option below that level. So what I will do is I will open this option chain. Here itself option chain came, and you can see 180 put option rate is 8.6 rupees, and 175 put is available, 170 put is available, 165 and 160. These all puts are available. And here you can see that OI is also available, means liquidity is there. So I will sell any of this. If I sell 170 put option, my risk will be very limited, but my reward will also be limited. If I will go far, my risk will increase, but my reward will also increase. So you can choose based on your risk reward which option you want to choose, because I will show you with 170. So suppose I take a now 170 put option and I am selling this, and I will add this position. You see 10,000 is my risk and 16,000 is my reward. You can see the here that my risk is 10,000 and my reward is 16,000. So risk reward ratio is 1:1.6. My risk is lesser, my reward is more. Almost 45% chances are there, and based on your technical and fundamental analysis also, you have seen that chances are high of going down a BHEL, because it now if you see that if the stock comes below 176, currently it is at 179, if it comes below 176, you will be in profit, and it profit will be same no matter how much it will go below 176. In previous case, when you are buying a naked put, prices profit will be continuously increasing, but your risk is 22,000. Now you have decreased your risk from 22 to 10,000, but your rewards are also fixed to 16,000. It will not increase. So that is your choice, that whether you want to increase your reward for taking 22,000 risk, whether you have that 22,000 risk capability. Now suppose somebody wants that I want to change this number, so he can play with this. He can choose that, he can select this sell option, whatever 170 he has chosen, he can sell 160 put option instead of that. When I sold 160 put option, my risk is 16,000, still lesser than 22,000, which I was getting in naked PE option buying, and my reward has increased to 36,000. Now my risk reward is 1:2.25. my probability has decreased to 40%. And now if stock is below 173, I will be in profit. So this is how you should do, and this is the maximum profit. But if you want to suppose BHAL fall from here, suppose BHAL increase tomorrow, BHAL will increase to 185 and you have deployed the strategy. Now you can wait up to expiry 27 March. If it doesn't come below this, you will be in loss of 16,000. Or in our previous case where we sold 170, here itself we will change it 170, I will change it to 170. And if BHAL will not come down, you will be in loss of 10,000. But if in the last week also BHAL suddenly drops and came down, because market, you don't know, Nifty is currently falling, it may go sometimes up and again fall. So you can wait. When you have some option strategy, you can wait till expiry, nothing will happen. And before 1 week of expiry also, if it fall down below your level, you will be in profit. Suppose it fall from here itself, and you are in a decent profit of 10,000, maybe not full 16,000, you are in profit of 10,000, you can book that amount. No need to wait till expiry, you can book that profit. So this is the beauty of option hedging, and doing it with a smaller risk. And this risk you can play with. If you have time, you come to Opstra, do this, make these strategies for n number of things like TCS, Nifty, Bank Nifty, and you will be amazed to see the result that based on your risk profile, you will get some strategy. Like suppose I want to make this strategy in Nifty. Suppose I want to change it to Nifty. So what I will do is, Nifty, this weekly option or monthly option I will buy. Suppose I think that in this March Nifty will come down below 21,000. So what I will do is, currently Nifty is 22,120. So I will buy 22,000. I will buy 22,000 put option. This one lot I will buy, suppose. And for hedging this, I will sell 21,000 put option. I will sell it. Nifty 27th March, what it came, what a beautiful chart it came. Your risk is only 12,000 and your reward is 62,000. Means at a risk of 12,000 you can get a reward of 62,000 if Nifty will be below 21,829. If Nifty is below 21,829 before 27th March, you will be getting a profit. So this is the luxury of making strategies by your own. Now you can experiment with it. Suppose somebody will tell that I don't want to take a risk of 12,000. He can sell that 21,500 instead of 21,000 put option. Easy peasy. This option, something happened, stuck. So again I will refresh and I will show you that if somebody change this number to 21,500 put with a 20 exit page, something happened. But this is how you should do. You can change and play n number of things. When I was starting to learn these things, it was very confusing initially. People were telling that this option you buy, this option you sell. But when I started practicing this in Opstra is a free website where I started making lot of strategies. Like simply I am sitting and I am n number of combination I will buy, I will simply sell something, I will buy something. There is no money involved, na. This is only need your hard work. Suppose here I change this to 21,500. Now I am buying 2,200 put and selling 21,500 put. Then I am getting a 8,900 risk and 28,000 reward. This and Nifty should be 21,800, below 21,800. Now if you go and see in the chart, here if you come and see in the chart, Nifty chart, you will see that 21,800 is a support level for Nifty, because in election result day, Nifty actually taken a support here and reversed from here. This was the day where Nifty fall almost 9% because of that election result came and BJP got only 230 seats. So now I know that Nifty has a support here around 21,200, and it closed around 21,800. So suppose Nifty will come down here. Suppose next week what happens is Nifty come down here and stays here at this level. And you are thinking now Nifty will go up. Maybe it will go up. your view is that Nifty will go up. Now you want to make a bullish strategy with call option. Okay, one thing is you can directly buy a call option, but that have a lot of risk because your full money can go. So if you want to make a strategy where your risk reward will be fix, so what you can do is you come to Opstra, you buy a call option. This I will delete first so I can start afresh with call option, because now my view is bullish. So what you will do, 27th March, suppose 22,000 call option you buy. 22,000 call option I am buying, call option. Okay. And this I will buy because my view is bullish. Okay, if you buy plain without any hedge, 22,000 is the 36,000 is the risk. 36,000 is the risk. Now if I will hedge this with 25,500 call option, I will sell it. This I sold to hedge that. Now my risk is 20,000 and my reward is 17,000, and 43% chance is there. If Nifty is about 22,200, I will be in the gain. So at least I know before the trade that what is my maximum loss, how much I can lose. And if I'm in profit, I can book before expiry. If you want to gain more profit, this 22,500 you can go farther. 23,000 call option you can sell. Then your reward will increase to 43,000. Your risk is increased to 31,000. And the same thing you can do in weekly option also. Suppose you don't want to see for that much far, your view is a very short term view. You want to play it very short term, like you don't want to play it that long. Now in charts we saw that Nifty has still room to go up to 22,200. Here 22,200 Nifty can go. Suppose with this chart we are seeing that Nifty can go up to here. So still this room is there. And now I see that Nifty maybe next week can go up and touch this level 21,200. Now if Nifty will be below 21,800, I will be in profit. How I can make that? I will change this to weekly expiry. This 6th March. 6th March I changed, and I will buy 22,200. 22,000 call put option I will buy because my view is bearish. So this I will add. And for hedging this 22,000, I will buy 21,500 put option I will sell. Your risk is 9,000, your reward is 39,000. This is how you can play in options. Your risk is 9,000, your reward is 39,000, your probability is almost 41%. If Nifty is below 22,000, you will be in profit. And you are seeing in the chart that Nifty can go up to 21,200. If it doesn't go also, this is maximum loss. This you will occur only on expiring day. Before that it will be 4,000, 5,000 only. So that time also you can decide to exit this strategy. If Nifty will start going from here onwards, it will start going up. You can exit. So just I wanted to show you that how in options also you can earn with learning. We can learn the option strategies with hedging, and you can earn a good amount when market is going up or going down. No matter, you no need to think about that much. You only have to think about your risk, that how much is a risk I am taking, and whether this risk is very little amount of my capital. Then I can play with both bearish and bullish direction trades. So hope you like this option trading video with an open mind, not thinking like options are bad only. If you play it with learning, if you learn and then you play this will also give a good amount of result. Anything if you do without learning, that will always result in loss only. So this is not time for swing trading. Swing trading requires market uptrend. So this time you can use with bear put spread strategies in the stocks where you see that stocks are overvalued and it can fall to a lot. So Hope you enjoyed the video and learned something new. If you have learned something new and exciting, you can comment and tell me, so I will be encouraged to make more option related videos. And you can subscribe, consider subscribing the channel if you find your time worth it to see this. All the best. We'll see you in next video.